Hi guys, thank you very much for joining this webinar. Sorry to keep you a little bit delayed here, but we're just setting up all three of us at the same time. Some of you might know us, some of you might not, but hopefully today we'll just be giving you some analysis following the Bank of England and ECB interest rate decisions. Nicole is going to start and give you the sort of the news headlines and her slightly more longer-term views, and then Alex will talk to you a little bit about sort of volume and momentum type of trades, as well as some preparation work he'd done earlier today pre-central bank decisions. And then I'll come over and just sort of give you a couple of flavors of some other currency pairs that I'm looking at, some levels, technical levels, short-term, medium-term, and so on and so forth. So I will hand you over to Miss Nicole Elliott.
Hello everybody, and I hope this goes well, and I hope it's of interest to you all. We thought we'd do this webinar following the Bank of England and the European Central Bank meetings, where they have both come up with this new idea called forward guidance. Mr. Carney has brought it over with him from Canada, and Mr. Bernanke uses it already, and it's the concept of telling you well in advance what is going to happen in terms of their policies. Now, quite frankly, I see it a bit differently. I see this so-called forward guidance as the last remaining tool in a toolbox that has been completely depleted. And even sadder is that journalists consider this momentous and a game changer. Anyway, we're going to start with... I'm going to start off with this cable chart, and you can see the sharp sell-off that we've had today. Admittedly, from the Ichimoku cloud and all the rest of it, things has not been going well for the pound. In fact, things have not been going well for many currencies at the moment. And the attitude in terms of financial markets is sell first, ask questions later. We've seen that in the fixed income in June, following the Fed's decision to taper. We've seen that in emerging markets, where it's sell the currency, sell the stock market, and then see what's going to happen later. And we've seen that again today. In terms of the Bank of England, they expect inflation to rise further in the UK, although they promise us that eventually it'll come back to target. Well, we've been hearing this same old story for I don't know how many years now, so basically no improvement there, nothing whatsoever. Also, interesting, and I quote them, the implied rise in expected future path of bank rate is not warranted. In other words, they're freaking out about the backup in yields that we've seen recently, both on the money market funds, because they quote bank rate. I always used to call it base rate, but they call it bank rate for some reason. Anyway, and so basically that's their problem. They know they cannot afford an even fractionally higher interest rates. We've got to have interest rates at zero, because that's the only thing we can do. So there we have it, and then in August they will be using this important forward guidance. In terms of cable, and we're trading down now, you can see my live charts here, 150.60 is the price at the moment, lowest price of the day as I'm talking. We do have a support level here going across at 150.35. It's recent lows in May and here, and then below that, if I flip you up to a weekly chart, you can see that we have sort of held at this sort of area below here, somewhere between 149 and 150 for most, but not all, of the last 4 years. Okay? So that's where we are. We are reaching an extreme level for the pound against the US dollar, but then so are many other currencies. Now, flipping us over to the chart of the euro, again, I think you'll agree with me that it too has sold off today on Mario Draghi's comments and his views on inflation. Basically, he's got three policies he's going to use. It's inflation, and he is convinced that is subdued, and I would agree with him. It's running at 1.6% year on year at the moment. His other thing he's watching is the economy, and still he thinks that the risks to the downside are far, far greater. And the third tool he's looking at, the key elements of his decision making, are what he calls monetary dynamics, where the growth in money supply is decreasing. Also, he says that the decision they made today to include this forward guidance was unanimous, that rates will stay low or go even lower for an extended period of time, and this is not 6 or 12 months. I mean, slightly odd wording he used here, but that's what we've got. And the reason they have suddenly decided to include this forward guidance is because the tightening in segments of the yield curve over the last month. So there you have it, same as the Bank of England. It's almost as if they've clubbed together and decided what they're all going to gang up and say. And so on that, you can see that the euro has sold off through the Ichimoku cloud. We are approaching long-term resistance, both horizontal and diagonal, and you can see here where I've got those. It's from the March low, it picks up the May low, and it's picking up today's low, where the lowest price we've got to so far is 128.85. It's also a Fibonacci retracement level. If I take you up to a weekly basis, you can see we have been here on many times over the last year or so. So, you know, it's not a game changer what he's done. Nothing of the sort. So don't panic. Things aren't going terribly well at the moment. So steady as she goes. Don't rush in. Above all, the idea here is that interest rates, both in Britain and in the Eurozone, should remain extremely low for a very long time. Okay? Now I'm going to pass you over to my colleague, Alex, and I'm sure he'll have lots of interesting things for you.
Okay, fantastic. Hi and welcome. Now, just look at a few trading tactics, and with specific reference, we're going to be looking at the smaller time frame charts, namely the 4-hour and a couple of 1-hour charts after the ECB and BOE event. And I actually did a couple of sessions this morning, live strategy sessions on both the ECB and BOE on our live update that we do on our channel, and wanted to bring a few things to your attention. And what's really important when you go into an event like the BOE or the ECB, and what I'm doing here, just my little slot at the moment, is focusing on trading tactics. And what I always do, and what a lot of professional proprietary traders engage in, is their ability to isolate the correct charts at the right moment and know what charts to trade on the various currencies. So you need to know which charts you want to be engaging, devoting most of your technical energy towards and your trading activity. So if we just start, firstly, I want to have a look at, first at the BOE. I did mention if we were going to get any surprise from the forward guidance, and as I can show you here, it's your ability to actually read the headline in fairly real time and know any subtle change from the BOE, any subtle communication change. And I actually used to sit next to a very successful trader a good 7-8 years ago who had a great ability to decipher the change in communication from the central banks. If you know the patterns of the central banks, just like the chart patterns, you can therefore make a very educated and high probability trade. Now, the main change was firstly the forward guidance, which and the Bank of England statement that came straight after the announcement, which you don't usually get. So this is obviously Mark Carney's effect, bringing over the Bank of Canada type of philosophy into the BOE. And as you can see by my mouse over here, the Bank of England, analysis of case for forward guidance to have important bearing on August policy discussion. Once that news headline hit the market, then that's when we got the effects. So when you have now prepared your charts, and one of the charts we're looking at this morning was the sterling CAD, which I'll show you over here, and we brought this chart to your attention, whoever was watching our strategy session, of a possible head and shoulders pattern. And yesterday we had a bit of a break above this smaller time frame channel, and we cracked inside of it just before the meeting. And sometimes I feel the market actually gives you subtle clues on technical clues of what the actual fundamental announcement could could be, and that was your first little clue. And immediately you start saying, well, if we do have a dovish statement, then this is one of the crosses I would like to participate in for a possible downside move. So that was on the sterling CAD. Another cross that we were wary of, and this is where I'm talking about the ability to isolate the correct charts that you want to trade. And one of those was the Euro sterling. Now, we did have this 86 level, but what was important is that not only did we have a BOE meeting, we had an ECB meeting and an ECB press conference. And it was dangerous to trade a currency chart because originally on the BOE meeting, we had the move to the upside on the dovish BOE comments, but we did know that there was an ECB meeting straight afterwards, and it was rather important that they could also come out with dovish. I mean, it would have been perfect if, for example, BOE, which they did with their forward guidance, and the ECB came and didn't offer anything. Then we would have sustained a bid. But always remember, knowing from a risk perspective of which charts to isolate. So that's Euro sterling. And another chart we looked at this morning was the sterling Aussie. And we brought to your attention this possible shooting star, gravestone, doji type pattern, and high. Critically important, this previous high was the 166.80. Any dovish comments, we expected to trade through this price zone. So really, it's the ability of the trader to understand the personality of the central bank, and when certain new communication comes into the market, of how the initial reaction will happen with the market. So that is from the sterling perspective. I'm going to quickly go through a couple of the euro trades. Now, remember with ECB's Draghi and really the ECB's communication for the last 10 years, they have always mentioned when asked on future rates is that they never pre-commit. Well, that was a massive change today. And when they changed it in an effective forward guidance, and if I show you on my news, and this is the news headline that ran through the Reuters news feed, was Draghi reiterates Draghi rates will remain at present or lower rates for extended period. Keyword there, extended period. After the initial release of the rates, nothing really happened in the euro, and it's when he mentioned that phrase, and that's when the traders who understand the patterns of the ECB, and in this case, the pattern of the ECB is that they never pre-commit, and again, you have to decide which charts to isolate, or which charts fit your best technical setup. And in this case, a few of the charts that we were looking at was the euro-dollar, which was at the top of a potential 4-hourly trend channel, that then offered down. Then we also had more or less my favorite chart that I was looking at this morning was the Euro-Aussie on the back of that shooting star, testing a previous high, and also locating that we did crack below this price zone over here, below the previous high of 142.35. Then the next obvious target was this upward sloping trend line that has taken us back since really end of April of this year. So again, just always remember, if you do preparation beforehand, like we did in our strategy session this morning, you can then do your post-analysis and review your trading game plan. Because when you're able to review your trading game plan on the back of your preparation, that is how you understand yourself as a trader and what were the best trades to participate in. Okay, I'm going to now hand you over to Laith. I hope that covers a few things and a few things of interest for you.
Okay, well, hi, thanks for joining the webinar, and you've had the news from Nicole, you've had the trading strategy and a bit of psychology from Alex, and now I'm going to talk to you and show you sort of some levels that we're currently watching in the market. So this is more a what to look out for and what to watch out for. I'm probably going to cover about 6 or 7 currency pairs. These are the types of alerts that we post on FX Street and the types of alerts that we do throughout the day. So let's get started. And obviously, it's probably best to start with the euro-dollar. I've got a lot of charts here, so just bear with me 1 second, guys. And I'm going to start with the euro-dollar and just have a look at a slightly longer term time perspective here. So we've had this move literally over the course of the last year, from last July, from 120.40 up to 137.11. We came all the way down, pushed the 50% retracement level at 128.75, bounce, came back, tested it again, went all the way up to 34.15, and now have come back. I have drawn this downward sloping trend line here, and you can see that so far today, even after the new policy stance from the ECB, that we've managed to hold. And the low that today we've seen is about 128.85, and that's pretty much where the line comes in at the moment. Now, what we've got, obviously, tomorrow is Non Farm Payrolls. Today, the US session is off, so potentially we'll get a bit of thin market. But the market might have just sort of, decided to wrap up for the day in anticipation of tomorrow. Now, the market often positions itself sort of closer to the time, so you could be forward thinking a little bit too early, if you know what that means. So let's just wait and see. But I want to also bring to your attention this mildly upward sloping trend line here that has connected the lows from around 126.70 to about 128 and marginally above 128 there, and that currently comes in at 128.15. So I mentioned this in one of my alerts earlier. If we did start breaking back below this line, and a line that presents resistance often provides support back on the way down. But if we did start breaking down below this, it might not happen in the US session, but it may well happen in the Tokyo session. Once they come in and they see the news, there is often a follow through, and you see that a lot of time when you get some news coming out of the US session. You very regularly get a follow through, at least a bit of a push or a bit of a follow through, not only in the Tokyo session but also in the morning of the European session. So it's possible that we might be done for the day in terms of a further push and a further test below today's current lows at 28.80, but we might get a bit of a push lower to the downside, but I would not expect it for today or even probably before the non-farm payroll to be seriously challenging this 128.15 level, which is where that comes in. But below that, well, we'll cover that in another alert should we get down there, but you've got to have your 61.8 fib retracement coming in at 126.78. Right, so and then I'm expecting any rallies throughout the day today to be capped anywhere. I mean, we have not even managed to get above 129.15 literally over the last hour or so after Mr. Draghi's finished his conference. So I'm expecting rallies to be quite short-lived between now and the non-farm payrolls tomorrow. And this is foreign exchange. Please be careful. Things can change any time. You saw that as an absolute perfect example on the euro sterling. I've been talking about euro sterling. No, I'm not going to show you the hourly chart. I'm going to show you this this daily chart. Next, let me just get that up for you. So, euro sterling onto my main currency pair, been holding 86, holding there again. Today, Bank of England comes in first, spikes up to the pretty much touch the 61.8 retracement level from the move that we've seen. If I just show you a little bit like that, a little bit clearer, from the move that we've seen from 87.90 down to the low of just a fraction below 84, the figure, that comes in at 86.40. That's where we spiked up to today. And very interestingly, after we spiked up there, the pair did not take long to come back and settle at 86.05, a fraction above the key breakout level that we have seen and waiting in anticipation. This is how jittery markets can be, especially around central bank meetings. So please
always bear that in mind. Be careful. Wait for candles to close. Wait for confirmation. You haven't missed it. There are lots of market participants who can come in after you in real money and opening new positions. So, always better safe than sorry. Well, look at that. We did break it, but we have not. We've been down to 85.50 after we've been up to 86.40. That's the risk when you've got these key events happening, and I especially have been, not afraid to say it, burnt many times on central bankers speaking and so on and so forth. So this is why you always have to wait for the dust to settle and then decide and see where the market has decided the real direction is. Not the intraday volatility, not the 10-minute volatility, not the hourly volatility. You wait for confirmation. Right, so that's euro sterling. We're continued in the same range until we break out of it. It's 84 to 86 pretty much. We've got this mildly upward sloping trend line as well, which we bounced very, very nicely yesterday. That was after the figures came out from the PMIs from the UK. They were very positive, as have many of the recent UK numbers been positive, but nevertheless we're just seeing a bit of a broad US dollar strength theme continue since the Fed meeting a couple of weeks ago. But tomorrow more will be revealed. Bear in mind that yesterday the figures that came out from the US were slightly mixed. The ISM was worse than expected. The ADP number was better than expected. That's why the market was up and down a little bit. Euro got down to 129.25, bounced all the way back up to 130. So, things are not particularly clear whilst everyone is talking about tapering, and at the next meeting they're going to start, and so on and so forth, or in the September meeting, things are not always clear, and every currency and every economy drags in its own direction, as you've seen very, very clearly today. So this is Euro Sterling in a very 3-month, very simple range here between 84 and 86. Right, what is the next one I want to show you? Okay, I like the yen crosses. I'm going to jump over to the yen and have a look at dollar yen and just see some of the price action that we've seen. So we've got, firstly let me zoom all the way out, back to the low that we saw back in November from when we started at 79, the figure. Okay, and we moved all the way up, respecting two separate trend lines. Firstly, the absolute lows that you've got here, and then these lows that you have there, as you can see, there, and there. And now if I zoom in and just show you a little bit about the trend lines, we broke the first one, couldn't get back above it, broke the second one, couldn't get back above it, came down, went all the way up, and actually over the last 3 days, these are daily candles. Each one of these candles represents a day's trading. Over the last 2 days, actually, we have failed above to get even close to them. The lines are sort of moving up 15, 20 pips a day, which is, as you would expect, as time goes by, an upward sloping rising trend line moves higher and higher. And currently, we do have resistance around here, and this is a very similar chart pattern to what we are seeing at the moment in the Euro-Yen pair, which I'll come on to in a minute. But nevertheless, from the 10 big figure slide, or 995 pip slide that we saw from 103.75 all the way down to 93.80, we have now pushed up, broken the 61.8 retracement level, coming in at 99.93, and had a bit of volatility around here, and we're currently just pretty much sitting on it. We're sitting at 100 and just waiting for the non-farm payrolls tomorrow. We've been supported by a rising trend line here, and that has literally been a straight line from the low of 93.80. If you take a perspective back, whilst we were collapsing, it was also rallies, but if you take a step back, this is just potentially a correction. Now we need to get back above this line and start consolidating and breaking above here if we're going to have a chance of continuing this. Otherwise, we could be in a maybe a 90 to 100 range over the foreseeable future. But we need to start breaking and pushing new highs if the uptrend is going to continue. But on a shorter time frame, on a daily chart, as you can see here, a nice simple trend line, tested today around 93.70, tested once again tested yesterday around 99.30, tested today again around 99.70. With every day that goes by, the steepness of this line is seeing a 30 pip rise approximately in the support level. Should we start breaking to the downside, well, you've got your 50% fib retracement of this move to the downside that capped the rally that we've seen. The first rally dropping the price all the way down to 97, the figure. That was coming in at 98.70. That's where I'm expecting your first point of good support to come in, and that is just above the 10-day moving average here, as you can see, which is the pink line. But, for the uptrend to continue, we're looking at a push to the upside, or a needed push to the upside. Right, so that brings me on next to my favorite currency pair, which is Euro-Yen. Let's have a look. Okay, so similar, up and away. We have seen a 33 big figure move from the low of 100. We've been down to even 94 exactly a year ago, 94. So we've had a big move up, and once again, look at this upward sloping trend line, broken, up, failed, down again, up, and failed, and down again, until we start breaking back above this trend line is so far capping rallies. You've got the Bollinger Bands very nice and flat at the moment with a range of about 6 big figures. Now, Euro-Yen can move, and when it does, it really does. We've seen that not only yesterday, but we've seen it today. Yesterday we had a high of about 131 and a low of about 128.60. Today we've had a high of about 130.20 and a low of 128.85. So I tend to also look at the 20-day moving average quite a lot on the daily charts. And I'll give you a nice example here. If you have a look at the 20-day moving average, so I've got my Bollinger Bands, which are the top band there and the bottom band here, and your 20-day moving average is the mean of the Bollingers in between. Now, when I see a break and a nice break to the downside like we've had here below the line, look at how it capped the rallies. It's capped it there, all here, 1, 2, 3, 4, 5, 6. The minute we broke above it and closed above it, we pushed higher to the top Bollinger Bands. Bollinger Bands are nice and flat, they're nice to trade in. When they start fanning out, and that normally follows a little squeeze in, as you can see, with the range there somewhere around 3 big figures, as opposed to this range, which is about 6 big figures. They squeeze in, they fan out. When they fan out, don't touch them. It means volatility's picked up, and it has indeed, as you can see there. Then they start cooling off and flattening out, and that's when you can start to trade them nicely. And you know, when you've got a general dollar theme going on, some of the cross rates are good ones to play, because you've got if it's a dollar move, then you've got, for example, dollar yen going up, euro yen going down, but actually, dollar yen going up, euro dollar going down, but the euro yen rate is actually quite stable in between that and can be traded quite nicely, and you see that quite a lot. So anyway, we've got your 20-day moving average. We've cleared it nicely now. We've touched the top of the Bollinger Band and this trend line here, which we have failed to break 1 day, 2 days, 3 days, and again today for the 4th time. So I'm expecting your first point of support to come in at 128.40. If we have a look here, I'm not going to start getting into hourly charts and so on. I just want to give you longer-term perspectives, because we could be here forever. But if you have a look at the move from 133.75 down to 124.95, as I said, we've come up to test the 61.8 retracement level at 130.40 and have so far failed. And your 20-day moving average actually comes in around 128.30. 128.40, just above the 38.2 retracement. And fib retracement levels, quite often they range between the 38.2 and the 61.8 levels. So until we start breaking out of here, and we could see it tomorrow, we might not see it tomorrow. As I said, tomorrow will be dollar focus. So with the scenario that I gave you with just both of them, then we might not actually see a break out of here. But nevertheless, we'll be watching this key level to the upside, and for me, probably this level to the downside. What else am I going to talk to you about? Right, let's just have a quick look at dollar Canada for you, because dollar Canada is a bit of a strange one recently. I'm going to, actually before that, since I've just done the yen crosses, let's definitely have a look at sterling yen, because sterling yen has potential to, potentially make a little bit of a crack at an important level. So look at this upward sloping trend line. Now, I showed you the upward sloping trend lines on euro yen and dollar yen, which are broken and the price is failing to get back above. But look at this one. We've got a low here of about 126, something like that. Another low there at 140, another low there at 147, and here this low, it didn't stick around there very long. Look at the move that we had there. This one, 3, 4, 5 days, we hung around this level before we managed to push back up to the upside. That currently comes in at 149.75, so exactly a big figure below where we're trading at the moment. We're last trading at 150.70. Yeah, we've been down today in sterling yen to about 150.30 when we were seeing some losses going through in sterling. But dollar yen's perked up a bit from about 99.70 and bounced off that daily trend line I've showed you. So that's sort of supported sterling yen for the time being. And interestingly enough, if you have a look at the 20-day moving average, it's right there. And look how that's capped the rallies as well. Here, capped. And we broke below it, didn't close below it, broke below it, closed below it, failed all of these, broke above it, went up close to this close to the top Bollinger Band and sort of these recent highs, and it's also the 61.8 retracement from the move from 156.70 down to the low of 146.08. So we failed at the 61.8 so far and rejected very, very heavily today. So we've also tried to break above this trend line, downward sloping trend line, which is, a close there below there today, and it probably looks like we're going to close there today. Could be construed as a bit of a false break, but we might be coming to a bit of a decision time soon here in sterling yen, and I just feel it because trend line gets supported, but not forever. So the level to watch out for sterling yen is 149.75, and to the upside, these consolidation periods and this 61.8 retracement level is your resistance for now. So I was going to talk about dollar Canada, and I am going to talk about dollar Canada. So I'm going to just jump over here 1 second. Sorry to keep you there waiting. Some of you might not have thought. If anybody wants me to stop, sorry, I think I'm just having a look at here. Anybody asking questions? If it's okay by you guys, we'll just leave the questions to the end because I'm just sort of engrossed in the charts at the moment, trying to give you levels and so on and so forth. So if that's all right by you, I'm happy to, literally answer one by one straight after the other. So let me just finish. I'm almost done. I just want to go through dollar Canada for you. Where's the dollar Canada chart? Here we go. Right, dollar Canada. Dollar Canada, here we go. Right, this is a 4-hourly chart, okay? So I'm also going to show you firstly a daily chart. Here we go. I'm going to zoom all the way out and just show you what's going on here. We had this long-term triangle chart pattern in dollar Canada evolving, yeah? And literally over the course of the last 3 months, we've been negotiating with it. And the last most recent drop down to 101.30 area, which is this low here, may have just been the last time, and we might be looking for a push to the upside. Now, let me zoom all the way out and just give you an idea of where we are actually trading in dollar Canada. If you look at the chart over the last 10 years, it's come from 150, 160 area, and now we're trading at 105, and we have been much lower, been down to the low 90s as well. So you can see that, on a longer term perspective, especially with these sort of divergence between the Canadian economy and the U.S. economy that we're seeing at the moment, with the Canadian economy still seeing sort of not deflationary pressure, but lower inflation and lower retail sales and so on and so forth, and the U.S. economy having potentially bottomed and just trying to inch up, even though we're still receiving mixed signals, but nevertheless it's probably more robust. We might have potentially seen the low here in dollar Canada on a longer term perspective. Obviously not on an intraday perspective, anything can happen at any point. But if I just zoom in there for you and just have a look at the levels we're currently at. So the recent low of 101.30 might have been the last time we touched this triangle. So we've negotiated for 3 months and finally spiked out, and we've made new highs there about 103.70, I think, and a new high there at 104.20, and now we've made a new high of 105. Let's call it. Well, I think it's 105.80. That was over the course of the last week, I think. But have a look at how we are trading up here at the moment. First, let me just show you this level we're currently at is the previous peak back in November, and if I just zoom out again, show you the next level up at 106.70 area. This peak back in back in quarter 4 of 2011, okay, we are sitting and trying and tussling and up and down, and even literally over the last few hours, we've had dollar Canada go down below 105, up to 105.45, down to 104.75, and we did an alert on that just like a few minutes ago before we started this webinar, and now we're back up at 105.09. So it's jittery up here, but every time it's coming down here, it's finding a bid. And look, after we got to this high of 105.55, came down. Bang, support, perfect. That previous peak before we went at 104.20, before we went all the way back down to 101.30. Previous peak held beautifully. So we really need to start clearing this level to make headwinds and move up to the next level up, which is 106.70. But obviously I showed you grossly oversold on longer term perspective. There you go, as I can show you right there. Right, and finally, very quickly, I promise you this, it's a Kiwi and the Aussie, and they've suffered a lot, we all know that. I don't have the Aussie charts to show you for the time being, but I just want to show you a quick Kiwi chart. Once again, longer term level that the price negotiates with. It doesn't just break and go through, it negotiates with up and down through, oversold conditions, profit taking, all sorts of things come into the market. Yeah, so we've got a low here back in 2010 of about 66, and I've joined this peak with this peak. There are other peaks that you can join. You can also draw different trend lines. People do draw different trend lines, so beware of that. There are, all of a sudden you'll see a hold at a level and a break of a level, and you think, well, what was that? That wasn't a level. But then maybe somebody's drawn a trend line or a triangle or something slightly different to you, and when you got large institutions putting in big orders based on their own analysts putting these things in, then you've got to be wary. I mean, the FX market is tricky enough as it is anyway. Right, so trend line we've negotiated literally over the course of the last 5-6 weeks with this weekly trend line, and now it just looks like we are just sort of consolidating below it, which is not particularly good for the pair. And lo and behold, let's have a look. We've come up to touch the 20-day moving average again, which has been very steadily, clearly trending to the downside since the beginning of May. As you can see, we've failed to break it there. We've failed to break it there. This is where the real move started. Until then, we were pushing and consolidating between sort of 83, 84 and the highs of about 86, and then we pushed to the downside. That was the first break when it had its back broken, just like the Aussie did when it sort of broke 101. And we've pushed to the downside, failed there, come up here, and we've got a potential bit of resistance that we're sitting on at the moment. But I just wanted to bring this longer term trend line to your attention and show you that we also have come down to just a fraction below the 78.6 Fibonacci retracement from the move up from May 2012, just over a year ago, of 74.5 up to the high of 86.77. We were negotiating with the 61.8 level that was at 79.21. We broke that. Look at that. We broke that. We went all the way back up to 81.30. This is the excitement of the Forex markets. But eventually, we came back down and decided, grossly oversold conditions there. Not a surprise when you're trading around key levels to have sort of rebounces and so on and so forth. So we're back down here below again. Your resistance is going to come anywhere around the 80 mark where this trend line is, because it looks like we may just have decided, okay, we're below it, we're consolidating below it now. A spike up there could see a cap at the 80 mark. Right, so I think that's enough charts for you guys. You've had about plenty of charts between the three of us. Happy to answer any questions. Please let us know who you are asking questions to. I think somebody had a question, first question, something about Nicole. Somebody was asking Nicole about a cloud, whether it was the thin cloud chart. Okay, shall we start with, right, Durv Stangvi. Okay, you were asking, can you just ask your question again, please?
Right, let's have a look. See if you can hear me, Durv. Nice of you to join the show. I'm guessing that you're asking about the cable cloud, so I brought the chart up for you. And you can see here the cloud is relatively thin today. I mean, it's not as thin as it is here, obviously, but it's a lot thinner than it was here, and a lot thinner than it has been on the way before. Okay, so I'm hoping that I've guessed at the right cloud that you're asking about, and you can see that it capped and the 9-day moving average is pushing us down, and it capped again today. But, you're not that far off that sort of psychological 150 level, previous support and things like that. So I don't know that there's going to be that much more follow through in this cable chart today or tomorrow. I think it's probably the bulk of the move is finished with. Now also FX, Boyki, I see that you've got a question about 20 S or E. I'm afraid I don't quite know what S or E are. I'm assuming that you're asking whether Laith uses simple or exponential moving averages. The answer is we stick with simple ones on most analysis here. Not always, but that's right. Okay? Yeah, okay. Yeah, sometimes keeping it simple makes life easier too. You know, I think we can overcomplicate issues. Obviously on some of the oscillators and things like that, then you would use an exponential moving average. But right, now back to the cloud question. What is unusual about the width of the cloud? The theory of Ichimoku says that when the cloud is very thick, it will provide plenty of resistance to a bull market or support in a bear market. And the thinner the cloud is, the easier it will be for prices to break through the cloud, and therefore the more likely you are to get a turn, a change in trend. Yeah? So that's the cloud theory. The cloud is always at its thinnest, yeah, when the upper span crosses the lower span. These are called lines. It's the different lines used to create these, which are based on the difference between those two moving averages, which, by the way, are not Western moving averages, and that explains why they go flat and across the page for so long. This is the highest high of the last 26 days, to which you add the lowest low of the, subtract the lowest low of the last 26 days, and you plot it as per normal. This one is over the last 9 days, and so that's why it's a lot more, there's a lot more movement. If you've had a major high and a major low, as we had here and here, that explains why the moving average goes sideways across the page. Right, the second question from Dhruv. But earlier we also saw the price going through a pretty thick cloud in April. Correct, you are. And that should have signalled a major turning trend. I'm afraid it didn't work. And cable really, if I want to be really cynical, if you think about it, for most of the last 3 years, you'd say, well, look, I've been somewhere between 150 and 163 for 3 years now, so no wonder a trending system like the moving average based Ichimoku cloud system is not working very well. Okay, and I think you can see it here on this weekly chart. I mean that sometimes it works, sometimes it doesn't. You go through the cloud and then you come right back down again and so on. That's the problem with a moving average based system in sideways markets. Right, I understand that Pan on Fire has the question for us. If you could repeat it, I'd be delighted to answer it for you, Pan. Let's have a look. Yeah, no, the Ichimoku is definitely better in trending markets because it is moving average based. Okay, so remember that. Now, Pan on Fire, here we go. Why didn't cable retrace? Let's have a look and wonder where we're retracing to or from, my question is. Do you mean this sudden sell-off that we've seen over the last 3 weeks, Pan? 50%, I wonder, 50% today. Why didn't we bounce today? I think, is that the question? That we had absolutely no bounce today. Good, okay, I've heard you. I think it's because sometimes you have two-way markets and sort of, shall we say, ebb and flow type markets, which are within normal markets, and then you have some days when you've got such a one-off shock that you never recover from it. So, for example, here in January, a massive shock in the first 2 days of January, you just didn't recover for it. Likewise here, massive one-way shock. Another one here, absolute shock to the system, you know, whether it was a piece of news or something else. Likewise here on those days. And it's quite interesting if you try to link that with the tides or something like that. You know, sometimes you have a tsunami and then it's all done and dusted. Most of the time you have something a lot less violent. Yes, it's valid for cable, but as I say, Pan, do keep in mind that the price action of the pound against the US dollar is quite unusual in that often, now I'm taking you up to a very long-term chart here, going back to 1992, where you can see that sometimes we have these major one-off shocks which we never recover from. And then at other times you can go sideways, broadly sideways, for several years. Look at this here, between 1996 and 1999, we were trading between 152 and 168. We're doing something similar at the moment, yeah? Right, that is CFTE, you got me there. It's the US, it's the diploma that you receive when you've passed your technical analysis exams. It's quite a long study course. This is the US, and it's certified something market technician or something like that. I'm not quite sure. Here in the UK, we've got a different one, which is MSTA. I've got that one as well, which is member of the Society of Technical Analysts. And the little E, you're right, I don't know, it's not e-commerce anyway, but excellent question, Boyke. I don't know quite what it is. It's a newish, this is a newish diploma. And eggs, yes, it could be anything. It's a newish diploma which is based on the International Federation of Technical Analysts. It's the International Federation of Technical Analysts that award this particular diploma. Probably certified financial technician. Yeah, I'd agree with you there. I'll go along with that too. Have we got any more questions from anybody else?
Fantastic. Hi, Gabrielle. My daughter's called Gabrielle, but anyway. Sterling Swiss. Right. Well, here's a tricky one, I tell you, because I have been looking at sterling Swiss. Me and Alex always joke about sterling Swiss, because look at this formation that it has been in literally over 2 months. And first it started out as a wedge, and then it became a trend channel, and it's been very, very tricky. And look at the volatility today. This is Swiss. You've got to consider something with the Swiss. Okay, you've always got potential protection on the horizon if you're long Swiss, obviously from the Swiss National Bank. But that they're watching more the Euro Swiss rate as opposed to the sterling Swiss rate. I mean, we've actually seen sterling Swiss go all the way down to 39.60, which is your low there. Yeah, so I'm going to look at this chart for you because it does interest me as well. Because if I zoom out here, and I'm just having, right, I think it was Boyke who asked why interesting that I look at Canada from such a long perspective. Well, you've got to look at Swiss, you've got to look at everything from a long perspective. Don't forget we've come a long way in currencies throughout the financial crisis. We've had big moves that we haven't really recovered from. So look at this on sterling Swiss, yeah? We went from 250 down. And this is quite funny because if you watch some of my videos, they're all short-term intraday baby pips. That's what Nicole calls me. But I'm actually looking at a chart here. You still must appreciate the longer-term perspective. So we've come from 250 pre-financial crisis. We've come from 270 in 2000. We've come all the way down to 116, if I remember correctly. I'm just going to zoom in there for you and get you that rate right now. Yep, 115. We've come down to about 115 and bounced all the way up to 154. So let's have a look at this most recent move, and you can see that, anybody who's watching sterling or sterling cable or sterling Swiss or any of the sterling crosses knows that at the beginning of this year we just had this big collapse. As you can see there, literally the pound got hammered against the euro, against the Aussie, against the dollar. Cable got down to 48.30 if I remember correctly. So we've had this downward sloping trend line, which we thought at one point we were going to be breaking, and we did actually break it. We got a big figure above it, but if you take a step back and look at the longer term perspective, yeah, okay,
okay, intraday, you could have you could have bought it and scalped it and made 20 pips and made 50 pips and so on and so forth. But you take a longer term look back, and potentially, you're looking at the trend still being in a downturn. Now, I was potentially looking at this as a potential, longer term beginning of an Elliott wave theory, where that's your first wave, second, third. And I was looking at this when I had it as more of a wedge. I think it was more like that at the time, and a sort of a falling wedge where you'd expect the next push to the upside. And I thought we could have this push at some point above this level. But don't forget, the Swiss franc, okay, is also, just like the yen, perceived as a safe haven. And whilst we have been pushing to the upside and things have been cheery and markets are rising, we do have problems on the horizon. We've got a bond bubble, we've got overinflated stocks, we've got potential deflation on the horizon, we've got zero growth. All these things don't bode well for economies, and central bankers are desperately trying to turn things around, but we don't see any solutions in sight as of yet. Interest rates can't go any lower. What do? Where do you go? You've got rising debt, you've got people failing to get out of this rut, and therefore you are always going to have this sort of potential shock factor, and the Swiss and the yen are always going to appreciate from that. So we were looking at this wedge and looking for a potential breakstart, but it's not, and look at even the volatility today. This is exactly what happened with that when I showed you the euro sterling chart as well. When we popped above 86, you've had that volatility. Look at this spike. Look at this spike getting down to 42.75 on sterling Swiss, and now it's 44.11. It's a whippy little currency, this one. Be careful of it. But on a longer term perspective, we are, again, just like many other currencies, grossly oversold, But on a sort of medium term horizon, and if you look at the rate back from August or even last July, 155. Now we're 11 big figures below that, and we have actually been almost 16 big figures below that, down to 39.60. So we need to start breaking above here, breaking above this. Trend line is forever declining. I believe that is your 200-day moving average also coming in at the same line as the trend line. We need to get above 146 to try and preferably above this level, to try and really start. Okay, technically we might have seen a bounce and a turn, and to try and move higher to the upside. But until then, with some potential shocks to the system, always possible. Swiss is just remaining strong. Even Euro Swiss, if you look at that, got up to 25.80 or something like that, and it came all the way back down. Even yesterday it was 22.90 or something like that. So the Swiss franc is always going to be supported by these potential negative shocks, as is the yen. They haven't done what the Japanese have done, the Swiss, but nevertheless they are sitting there and watching it pip for pip, believe me. Right, so let me just read your questions. 1 second, guys, 1 second. Do you have dollar ZAR? Yes, I'm going to swing the screen over to Alex for you, and he's going to have a look at dollar ZAR for you. I don't actually watch it, but being our South African chief technical trading strategist, I'm going to pass the screen over to him straight away. 1 second.
Okay, great. I think the question was from FX Boyke. Boyke sounds like a South African. Just looking at the ZAR, I've actually been watching it quite closely for the last year, and I always compare it to the VIX index because, and you can also ask Nicole Elliott her thoughts on these, currencies in the more emerging BRIC nations. And as you can see, we can go through extended periods of really low volatility. And when everyone decides that there's a shock on the global economy, all the money gets sucked back into the developed nations such as Europe and the UK, as well as the US, you get these excessive moves. And also remember, we're at the mercy of commodity prices, and we saw what happened when China missed its GDP target. I think it was in May sometime, May or April, and we saw what happened to all the currencies. But one of the techniques that I actually utilized personally for my own trading strategy, which I want to bring to your attention, was on the back of this very important base area over here, and I was really watching the ZAR around the 820 area. And what was quite important is that at this time we were having the Fed still in the midst of easing. But at the same time, we had all these mining strikes happening in South Africa and various political unrest. And what was quite noticeable is, whilst all the other currencies against the US dollar were strengthening, the actual ZAR, or the South African Rand, was unable to strengthen. And sometimes that is my first clue of a currency to isolate and pick out in the event that all of a sudden, once the US dollar turns around and starts strengthening instead of weakening, this is the currency I want to be involved in, because it was one of the weakest out of a strong pack. So I don't know if that makes sense, but effectively, when you have these big shifts and tidal shifts in certain of the majors, but one of the other currencies aren't moving together, and a case in point it was in the Australian dollar when we had that against the yen, which I could try and show you over here quickly. If I just show you, I'm just going to show you one of the examples that I'm speaking about on the Aussie yen. And what you can see over here is this little almost double top formation, and we were, in regards to the yen against the sterling, as well against the yen against the euro and the yen against the dollar, where we actually went for another leg up against the yen, where the yen weakened for another bout. And the only one that could not participate was the Australian dollar. So the moment the yen strengthened across all the currencies, that was the time to actually go short this cross, because this already was illustrating fundamental weakness when the yen was weakening against all the other crosses. So again, that's the same type of view that I use with this chart over here. Yes. Hi, Leonardo. Just usually someone starts leading a reversal. If I understand what you mean, starts leading a... Yes, exactly. Case in point was with the Australian dollar against the yen, if I understood your question correctly, and the same with the ZAR in that case when we had the mining strikes. And you really have to be, sometimes when a pair isn't moving, and all other pairs are moving. That's, for today, what happened with the sterling and the euro against many of the crosses. Today is when you go do your homework and you start analyzing which markets are uncovering and showing true strength on weakness. And then when the tide shifts the other way, those are the crosses you want to be involved in, if that makes sense. And thanks for that question, Leonardo. That's exactly it. Does anyone want to answer that question? Yeah. I'll pass that question over to Laith. Okay, Laith's just going to speak.
Pan on fire. Hi. Right. Aussie dollar, has it bottomed? I've probably been asking myself that question since about 97, the figure. It's a very tricky one, and obviously you've probably heard the expression, do not try and catch a falling knife. And if I can say this on air, bottom picking is a smelly business. You want to base your sort of analysis, strategy, entry points, etc. on, if you're looking at charts. If you're looking at fundamentals, you base it on fundamentals. You want to look at signs for an economy improving and so on. You look at the gold price, it's collapsed, and the Australian economy has a lot of mining, as you know. So that's keeping it under pressure. Technically, this is my Aussie dollar daily chart. By the way, guys, I'm showing you long-term stuff, but most of my stuff is very, very much intraday trading. But I cannot get into all my charts here possible because we're watching 150 charts here for our viewers normally. But I'm just giving you longer-term perspective. So this is the Aussie longer-term perspective from 2008, where we were trading at 60. we moved all the way up to sort of, I think it was 110.80, yeah, exactly, 110.80, and then we've been in this triangular chart pattern and failed at around 106 several times. There, 1, 2, 3, 4, 5, 6 times, and then pushed. Once we broke below it, again, negotiated, flirted, call it whatever you want, with this trend line, and I'm going to show it to you right. You can see a little bit like this. So we actually didn't do that much negotiating with the Aussie because it just had such killer momentum that it just pushed through and barely came up to test it. It has not even tested it once. And look at your moving averages. This is on a daily chart. Okay? This is your 10-day. This is your 20-day. Do you see any sign? Do you see any sign of a technical reversal, or do you just see the price anytime it gets above the 10, fails at the 20, fails at the 10, fails at the 10, comes down, fails at the 10, manages to get above the 10, fails at the 20, comes back down, fails at the 10, fails at the 10, up to the 20, fail, and drop again, up to the 10, fail, fail, fail. Is there anything technically here that shows you that this pair is turning around? Of course, you can grab a pip here, 20 pips there, 30 pips there. You're getting dollar moves a lot of the time, and the Aussie will also benefit as well when you're getting a dollar weakness theme throughout a day or after a number or whatever. But it depends on your trading strategy. I'm not. I can't see anything technical that would allow me to believe that we have a bottom in place in the Aussie dollar. So let's just zoom out again, have a look at where we are on a longer term perspective. So we've broken below this triangular chart pattern that we've seen over the course of the last sort of year and a half, something like that. And we have come down to the 38.2 Fibonacci retracement level from this whole 50 big figure move. Okay, 50 big figures from 60 all the way up to 110. That is 50 big figures, and we have literally collapsed 14 big figures in the space of a month or something like that, a little bit more than a month. So we've come down to touch this level, and we do have support here. I mean, we have found support here so far. The low today has been 90.75. That's when we were seeing dollar strength again earlier. But we're back up to 91.50. So markets are oversold, as you can imagine. But nevertheless, rallies are very much short-lived. I would say that we do have support here, and if you take a longer term if you're looking for the very first bounce off a level, then the very first time we got down to this level, I'll show it to you, the very first time we got down to this level, 91.45, bounced all the way up to 93, the figure, okay, and then pushed higher up to 93.44. I often look at a first time bounce as a good trading opportunity for at least 20-30 pips, depending on how big the level is, and this is a pretty big level, yeah, but I also look at if you smash through a 20-day moving average, for example, the very first time you get up there, you regularly see resistance or support depending on which way you went. But yeah, we've bounced off here, we come back down, but on a longer term perspective, we are now sitting at the support level, and we could be sitting here for some time. You don't know. Considering the grossly oversold conditions, we could be sitting here for quite some time. And if you follow my mouse across the screen, you can see that this level is also these previous peaks here. Give or take a big figure or two, or even 3 big figures, because you have to when you're looking at such a long-term perspective. I don't know your trading style, but if you're going short-term, then you've got to be tight. But, then again, this is FX, and market always goes further than it should, and being tight will obviously often stop you out, whereas you might have had a perfectly good trading position. Yeah, so you've got to understand your strategy, your risk management. Never, okay, I think it can still go to 85.50 and 85.75, which is a 50% fib retracement level. Leonardo Shane Singer, what a great name. Leonardo, anything can happen in the foreign exchange markets. It is very possible, and as I said, on the technical chart, there is nothing that makes me or leads me to believe, or even gives me an inkling to believe that this thing might have bottomed. So it is very, very possible. there's something that the market's looking at the moment, okay? It's market's forward thinking, and it's thinking, right, now the ECB, for example, have all of a sudden they've changed stance, okay? They're looking at, and when Mr. Draghi was questioned today about what is what's the extended period, is it 6 months, is it 12 months? He said no. It's not. It's an extended period, and that's full stop, Don't ask me how long it is, because, they've slightly changed stance. So now that could potentially be looking at, on the euro crosses, maybe capping the recent rallies on some of the euro crosses that we've seen, and maybe even against the dollar. Now you look at the US economy, where they're talking completely the other direction. They're talking coming out. The ECB is talking about, we're going to protect ourselves from further downside. We're going to keep rates on hold, or even lower rates. So, we are not even out of the woods yet, whereas the US is sort of hinting at, completely the other direction. So you've got to bear in mind that markets forward thinking, and what on longer term, not intraday scalpers, not guys who are holding positions for a one day. You've got to think about investors who are taking positions for the slightly longer term. You've also got to check your COT charts as well, the commitment of traders, because that's also very interesting. You can find that online. That's very interesting to show you market participants and different types of market participants, which show you their positions in the market. And you often have speculators going one way and hedgers going the other way, because they're actually needing to hedge their positions against the business. But on a longer term perspective, now sort of people are looking at dollar being supported in the future, because they're talking about tapering. And we're not talking about interest rates here, guys. None of us in this room believe that interest rates are going anywhere for any of these economies anytime soon, and I'm talking at least a year away, not even a hint of talking about it. First, let's deal with the cheap money that they've been flooding the market with, and then we'll start thinking about interest rates. But no, the American economies, all right, it's coming out, but it's not particularly robust job data or anything like that, and that just shows you by the data that we had yesterday. Signs, glimmers of hope for the UK, but, we're very much a service-orientated economy here, and, we really need to start pushing much higher. And look at the forward guidance. Obviously the central bankers are still worried, and you've got the same thing with the ECB today. So, you've got a lot of things to consider, but dollar is potentially going to stay supported, to finally answer your question on the Australian dollar. And don't forget where the Aussie rates are, yeah? The Aussie rates are much higher, and they have the potential to come down. The Australians do not want to see their currency so strong, and they've been talking about it since, for some time now, and they must be very happy of this move to the downside. Right, sorry, just 1 second. Euro dollar, do you believe that 128.15 will hold, and maybe after tomorrow's non-farm payroll it is time to go long or not? Right, Alex? Yeah, no, I mean, you're probably asking because I showed you that 128.15, which was the rising trend line. Yes, is that right? Yes, okay. Bossy, another Bossy Euro dollar to all panelists, fantastic, another great name. Bossy, to be honest, there are some scenarios that could happen tomorrow post non-farm payroll, okay? And it is actually possible. Now, you've got to remember that what the Fed are doing now is they've come in and they've started to, Mr. Bernanke at his testimony started talking about the tapering, yeah, and this is what's keeping the dollar supported for the time being. However, if you noticed, you had a lot of other policymakers and officials and so on trying to calm the markets after he did that, yeah. So he comes in and gives you the news, and they come in and sort of try and settle things. And some of them also have different opinions as well. So you've got to be aware of the news coming out all the time that is moving the market, at least on an intraday basis. I think we've all agreed that sort of the U.S. economy is starting to pull out, but at the same time they need they've come back and said, before they were talking about 6.5% as an employment rate before they start tapering. Now some of them have even come out and said, well, well, maybe not necessarily, maybe it has to be lower than 6.5% unemployment rate. So, you've got to consider all of these things that are coming out at the same time. But tomorrow is non-farm payrolls. Okay, today, so you've had it today. You've got your euro weakness, you've got your forward guidance, you've got extended period of these rates or even lower rates, so you've got it. So that's definitely capping the euro for now, yeah? But tomorrow, all of a sudden, you could have a scenario of a not so impressive number. I mean, we had the ADP numbers come out yesterday. The expectation was for 165,000. I think we got 188,700 or something like that. And, the euro ticked lower, but didn't really tick much lower. It was trading around 129.70, went down to 129.45, and within an hour is above 129.70 again. So you've got to consider that market, yes, okay, well, we're thinking that the US is coming out and slowly getting better. These numbers aren't as impressive as you think. Yeah, your knee-jerk spike reactions are not always the reactions that will continue. That's why I said to you at the beginning, you've got to let the dust settle with these things and, look for the direction that the market has actually decided to go in after the intraday volatility. I never trade non-farm payrolls. I just sit back during Mr. Draghi's speech and I just look at the market and move and see the comments that he makes and how they affect the price action. Then I come back at the end of the day and see, right, where's the price settled at? Where has the market decided? Because he could say one thing at 1 minute and he could say something else in another minute, and you've taken a position based on one of his comments and then you're stopped out because you're going for an intraday quick move. So, tomorrow we could have a possibility of a potentially average non-farm payroll number, in which case you probably have an immediate reaction in the euro-dollar, slightly tick to the upside, okay? And the reason for that is the market is thinking, oh, okay, well, we're far away from jobs getting better or whatever, and as you can see by these numbers, I think, we need 300,000 jobs created every month in the US to start seeing robust growth. So, the numbers are not particularly attractive at the moment. So if we get an average number, euro might be a little bit supported. But, as time goes by over the next sort of year or so, the economy, the fact that the US economy are coming out a little bit sooner than everybody else, while some of them are still going down, could keep the dollar supported, and potentially euro-dollar might have a crack at this 128.15. It is not a very big level, by the way, 128.15. I'd say just below 127, the figure is probably a bigger level for me. 128 is just a bit of a. Are you guys sharing my screen? Let me just jump over here back to the euro-dollar chart. 1 second. I've got it here. Maud, are we running out of time, or can I continue to answer questions? Nicole's got gold ready. Right, I'm going to wrap up real quick, guys, because. Okay. All right. So, how do you gauge stops? Difficult to enter with news out all the time. Yes, it is. It is very difficult, and foreign exchange trading is very difficult. I'm not going to deny that, but you just have to be careful. You've got to have risk management. Thanks, I agree, as I am a big euro bull and I will try along. Fantastic. Okay, thanks, Maud. Right, so how do you gauge stops? Okay, it depends what your trading strategy is. Are you going for 5 pips, 10 pips, or are you prepared to sit on a position for 3 days with a 100-point stop to go for a 2 big figure move, hopefully get in at the right level at, technically, fundamentals, technicals. What I look... Okay, your comments, Boyke. I'm almost finished, Boyke. I'm just answering Bossy's or somebody else's pan on fire. Sorry. So I look at the general trend. Okay, so for example, okay, if we didn't have non-farm payrolls tomorrow, I give you, there's a perfect example. This is how I trade. If we didn't have non-farm payrolls tomorrow, that's it. I'm selling rallies on euro dollar and euro. Well, at least on euro dollar until I get the next signal that I need to be buying dips, or until I get the next signal that it is now in a range. But obviously, there's 1,000 things that you need to consider. Are we already on the lows? Do I want to wait for the price to retrace up to a technical level where I think is a good level to sell, or a breakout level that we had before? There's tons of things to consider. What economic numbers we got out today. I'm talking to I'm talking to Pan on Fire now about how to gauge stops, because there are literally so many things you have to consider. When are the numbers coming out? What is the general feel for the market? Don't forget, guys, most of the time the market is trending. It's ranging. It's not necessarily, most of the time the market is ranging. It's not trending. So, you've got trends on a 5-minute chart, you've got trends on a 4-hour chart, and you've got trends on a monthly chart. Yeah, so you've got this is fractal analysis, and you look at things with patterns within patterns as well. So you've got to basically assess your own risk management and how much you can afford to push out your stop. You've got to get in at the right levels, or you've got to get in at proper levels if you're looking for a breakout. But if you're looking to trade ranges, then you've got to catch levels that you feel comfortable with, not just anywhere. Everybody's done it. Buy the highs, sell the lows, false breakouts. It catches people out every day. It's very difficult. But for me, there are 3 things in foreign exchange trading. Number 1, don't be greedy. Number 2 is about risk management. And number 3 is patience. Lots of people trade in and out all day long and end up losing all their money. And it's a fact of the business. You've got to be patient, wait for your levels, confirm with your technicals, learn your technical analysis, confirm with your technicals, get the right news tools and information at your fingertips, and execute at the right prices. Be sensible. Nicole's ready for gold now. Fantastic. Okay, I'll pass you over in 1 second.
Hello. Here we've got a gold chart. It's a daily one, and what you can see, I think you'll agree, is that we've had a particularly nasty sell-off. The biggest one here in April, and then another one here in June. And everything about this chart looks as if we're stepping down. Look at the clouds. Across, down, moving averages, most of the time very, very tightly packed and pushing you lower. So I'm afraid at the moment all we've seen is the smallest little bounce. I've drawn in a Fibonacci retracement taken from that June's interim high, the interim high in June, down to here. And as you can see, this little bounce is only corrected just under 38%. So we're still well under correction mode, the smallest little correction after such big moves. The same thing happened on this one here, that was a 50% correction. This as well, a 50% correction. So these are relatively small bounces in the scheme of things. Taking you up to a weekly chart, you will notice that we had this enormous, very, very nasty sort of a right angle triangle top. And I've drawn in some of Fibonacci. Anyway, that's roughly a triangle. And this is the reason we had such that big sell-off, is everybody knew, because all the interim reaction lows since the record highs had come in at or just above $1,520 an ounce. Also interesting to remember that you may think of gold as this, I think of gold as this, but other people see it completely differently. If you are in Japan, you'll be constantly monitoring the Tokyo Futures Exchange, where it's priced as yen per ounce. So do not assume everybody looks at it this way, and do not assume that it's losing or making money for everybody else. People in India actually still, understandably, see it as a store of value, because the Indian rupee has lost an awful lot of its value too. What I've drawn here now are the Fibonacci retracements taken from the low in the 4th quarter of 2008, and as you can see, we have given up more than half of those gains. All right, half of those gains already. I'm expecting a drop to the 61% Fibonacci retracement, where we will merely try to stabilize, because the reason I say this is because actually the bull market didn't start in 2008. In 2008 was when some of the bankers realized that it was an asset class worth looking at. But actually the move started actually in 1999 when Chancellor Gordon Brown sold off all the British gold reserves. Okay? And what you can see here is currently we are under the 38% Fibonacci retracement. We've stopped in no man's land, really. $1,150 there is a little bit of support there, but it's probably only a temporary lull. More likely, we're going to stall somewhere between the 50% mark and those highs from 2008. I think that's the more likely level where you might see a meaningful base emerging, and that's because it's at the $1,000 level. Okay? So keep that in mind, a round number, whatever. I'd say far more importantly, this secular bull market has come to a very, very frothy head, and we are unlikely to take out those highs for many, many, many months, possibly years. So in terms of your asset allocation, I'm very much an investor, not a trader. In terms of your asset allocation, I would be very, very wary of buying something like this. I think you can put your money to marginally better use in other things. And as for year-end predictions, no, I don't do those. I don't believe that investment can be neatly put into 12-month segments that start in January and end in December. I'm far more one for going in when I think that it's a good entry point and coming out when I think I've had enough or the ride's too bumpy. My investment horizons can be anything from, a week to 10 years. And I just think that, starting in January and deciding what you're going to do with everything and then deciding that you're going to close it all up in December is not the way one works. And you can see this clearly what's happened in June with so many hedge funds and bond funds, that they have had record redemptions because people just aren't prepared to wait until December to exit these horrible losses that they've been seeing. But basically I think gold will go down towards about the 1,000 level really before it starts stabilizing. In order to do so, I think it has to stay below the sort of $14,000 mark. So that would be the sort of $400 trading range that you might be, I can't even say look forward to seeing over the rest of the next 6 months. Right, I think if we don't have 10-year T-note, yes, I knew somebody would ask about that. Excellent question. Glad to see people are on the ball here. And look, I've got it all set up for you already. Just zooming in here, we'll start with the daily chart. And you can see the phenomenal backup in yields from 160 to 266.6, 2.666. That's a massive backup in yields. In other words, you've added 100 basis points to something that started at just over 100 basis points. This has had a massive effect already in the US mortgage market, where I understand that benchmark 30-year loans from Fannie Mae & Co. are up, I can't remember how much it is, but it's at least 100 basis points. And more frighteningly than that, the student loan rates have doubled in the last week. Student loan rates, don't quote me on this, I can't remember the exact figures, but I think they've gone from 3.4% to 6.8% or something like that on student loans, which are currently some of the biggest loans outstanding. They're bigger than all credit card debt put together and all consumer loans put together. So that is a terrifying thought for these poor students that are graduating to no jobs. I really, really sympathise. What we've seen now is a small pullback. I'll take you up to a weekly chart on the notes. And this backup in yields represents a 50% retracement of what QE did. Oh dear, oh dear. Another notch there for poor chauffeur, a central banker, isn't it? I'm afraid another one's not going to go out on a high note. What we do have here is a massive shooting star, though. So I do think we've come to an interim high in yields. I've got a feeling that there's a very good chance that you're going to dip back under that sort of band that we had been in, and that we're going to hover back in the 2.3% range over the next couple of months or so. And you've got, has already happened in the Bund market, which I've got on another chart, but I won't go into that, but they're very, very similar. You can see how related all these fixed income products are. So basically, I think we've seen a spike high on core yields. By core, I mean UK, US, Eurozone, and a couple of other Swedish ones and things like that. We've seen a spike high in their yields, trough in their prices, and we should go back to a steadier, more even trading background on those at the moment. I think we're done for today. I think Laith would have one last word, so I'll pass him.
Hi guys, well thanks a lot for listening. Hopefully that was useful for you, and thank you all. You're welcome, Pan on Fire. Just a little bit about us. We've got a live technical analysis TV channel, and this is what we do for you all day long, every day. We stream about 20 to 30 videos, live streams to your to our website where our online TV player is housed, and basically we're streaming charts to you all day long. And you were asking about where do we get all these news from? Well, we give you all those news as well, and we comment on the markets throughout the whole day, depending on volatility. Sometimes you will have 20 videos, sometimes you will have 30 videos. We've also got our app coming out soon, which will bring to your attention every time we publish the video. You can watch it straight on your phone or see all the news that we publish. You can also see all of our trades on there. We're here to help you, and basically we're happy if you want to take out a free trial on our website and let us know what you think. Maud, thank you very much for this opportunity. It's been thoroughly enjoyable. And okay, chart layout. What platform is it? That's another interesting. We are actually a partner with Thomson Reuters Metastock, and all the charting software and all the news that we use at the moment, and all the huge amount of technical and fundamental tools and deep analysis tools that we use, all come from the Thomson Reuters platform, which is a retail platform, a new one that they've come out with, and it is really an unbelievable product. And if you go to our website and you sign in, you register, you can try it for 1 month for free. It is basically institutional level. It's what the information that the bank dealers have, and I just tell you that once you've tried it, you can't let it go. So if you want to try it, you're welcome, all of you, to try a free trial. We've got a 3-day free trial on our service, and then after the 3-day free trial, it's £15 a month for the service, and you're getting about 500 technical analysis videos a day, and a lot of them are intraday between myself. A month, not a day. We get about 20 to 30 a day. Nicole just had a laugh there. We get about 500 technical analysis videos, so we alert you to things as they're happening and teach you technical analysis as it's happening throughout the day. Mostly on the Forex markets. Have a browse of our site, and we're very happy to, if you like to have a 3-day free trial. You need a beer. FX Boyki needs a beer. Okay, well, it's almost time. And if there are any American watchers, by the way, happy 4th of July to all of you. Oh, I need a beer. FX Boyki saying I need a beer. Yep, I could go for a beer a little bit later once we've wrapped up here. Thank you very much, guys. It's been a pleasure to help you guys all out. Thanks, Maud. Bye.